Joining me now, Wealth Enhancement Portfolio Consulting Director Ayako Yoshioka. Ayako, market performance last month was nothing short of impressive. NASDAQ alone saw a 4.7% jump. I mean, what are you looking for this month?
Hi, Liz. Yes, we've seen 6 consecutive months of positive returns for the S&P 500. And we enter the last 2 months of the year. Seasonality is supposed to be in our favor, but seasonality was supposed to be out of favor in September, and we saw a strong month. So could we see a little bit of a reversal, some pressure as we go into the year end? We don't think so. We actually think we're going to continue to see this momentum in the S&P 500 and in markets, as long as we don't see an outside catalyst really disrupt this trend.
What could be an outside catalyst? And is it anything related to the very inside topic of AI? You just saw the deals that we rolled out today alone, billions and billions of dollars. Perhaps there's something, I mean, all roads, as we said, lead today to NVIDIA, but in the past it's been to OpenAI. OpenAI is part of a deal as well today. What do you think could be an outside issue?
Sure, Liz. So I think we've all been talking about AI, whether it's in a bubble or not. The CapEx spend has really garnered a lot of attention since the start of earnings season. And just to put it in context, I think we've seen economists suggest that without the spend in data centers, real GDP in the first half of 2025 would have been flat, only up 0.1%. And so we need to continue to see this spend going into 2026. And the magnitude of this spend is just enormous. I mean, expectations are now at $520 billion for 2026. And to put that in context, the pandemic spend from the government was $700 billion. So it continues to ratchet higher, and we shall see whether or not this continues to aid overall economic growth as well as growth in the tech sector.
That's an interesting comparison back to how much the government spent to keep this U.S. economy afloat back during the pandemic. Let's talk about earnings, because they look pretty good so far. I believe 83% have been, of the 63% S&P names that have reported, 83% have beaten on earnings per share. We've got 80% beating on revenues. Things just look pretty solid at this moment. But when you take out the Magnificent Seven, these big tech names that have reported so far, I'm thinking Amazon, Apple, Meta, Microsoft, Alphabet, how do earnings really look?
So from an earnings perspective, I think expectations were for growth of 6% year over year for the overall S&P 500, and we're tracking at around 8%. It's the reactions to these earnings reports have been hit or miss. Even though we've seen positive earnings, positive revenue beats, and earnings beats, the reactions from a stock perspective have really been mixed. And a lot of this has to do with just where we're starting in terms of valuations. We're already at such stretched levels that it's really tough to kind of keep pushing higher.
You got this Kimberly-Clark Kenvue deal. Is there a way to capture some of that without buying either one of those stocks?
In consumer staples, we like a name that's like Mondelez, which is more on the, a snacking side of the consumer staples world. We think that, over the long term, we like Mondelez. It's a diversified portfolio. It's one of those things that, that it has 40% emerging markets exposure. It's been sort of hit by higher cocoa prices, but we think that going forward into 2026, that can alleviate a little bit and get back to better margins for Mondelez.
Yeah, and you like J.P. Morgan. That certainly can, as a money center bank, can capture some of the deal business. That's your pick there. Ayako, thank you very much.